The morning of March 10th, 2026 feels different if you're paying close attention. Not because of market numbers flickering on your screen, not because of another geopolitical headline before you have finished your first cup of coffee. It feels different because something broke yesterday, something that has quietly held the entire global financial system together for 50 years. And the connection between what just happened across the Gulf and where one specific metal is heading has not been made by a single major outlet, a single Wall Street desk, or a single mainstream analyst. I am going to make that connection today, step by step. With math, you can verify on your own screen the moment this ends. My base case price target for silver is $280 per ounce. My conservative first target is $150. Those numbers do not come from optimism or from what sounds dramatic on a thumbnail. They come from two specific inputs: the trajectory gold is currently on, and the level the gold to silver ratio historically reaches in every precious metal cycle that shares the same structural characteristics as this one. I'm going to walk you through every calculation and every data point, so that by the end of this, you either agree with the math or you can tell me exactly where it is wrong. But before the numbers, if you are watching Element Axis for the first time today, hit subscribe and turn on your notifications right now. This channel is where we go deep into the real mechanics of how precious metals, commodities, and the monetary system connect to each other and to your actual financial life. Not noise, not speculation dressed up as analysis, real math and real market structure. If that is what helps you make better decisions in the morning, subscribe now and stay with me. What comes next connects dots that most people watching silver have not seen yet. On Monday, March 9th, 2026, Iran launched coordinated strikes across multiple Gulf nations. And I need you to understand what those strikes actually targeted, because how it is being reported does not fully capture the weight of what occurred. These were not warning shots aimed at empty desert. Refineries in Saudi Arabia were struck directly. Liquefied gas facilities in Qatar were targeted. In the UAE, footage showed fires consuming critical infrastructure along some of the most developed coastal zones in the region. Power generation hubs, airports, and shopping centers, all in the line of fire. But here's what almost every analyst is glossing over because they are focused on oil prices and equity futures. Water, desalination plants. In Bahrain, a single strike took out a facility responsible for 75% of the country's entire drinking water supply. Not oil, not luxury real estate, the water supply. In a region where fresh water does not fall from the sky or flow through rivers but is manufactured industrially from the sea, that is not just infrastructure damage. That is a civilizational vulnerability being demonstrated to the world on live television. Look at the dependency numbers. Kuwait gets 90% of its fresh water from desalination. Qatar is at nearly 100%. The UAE sits around 90%. Saudi Arabia at 70%. Every single one of those nations just watched their most irreplaceable infrastructure proven reachable by Iranian weapon systems. And then they waited to see what the United States would do about it. The American response in practice, in real time, while Gulf leaders watched their own infrastructure on fire, did not match the promises that have defined the arrangement between Washington and the Gulf monarchies for 50 years. Political and military attention was directed elsewhere. And the signal that sent to Riyadh, to Abu Dhabi, to Doha, and to every royal household watching those broadcasts was not ambiguous. The security umbrella that justified 50 years of Gulf financial loyalty to the United States dollar showed its limits on the world stage, plainly in a moment when the stakes could not have been higher. Now, I need to explain what the petrodollar system actually is. Because if you do not understand the plumbing, you cannot understand why what I just described is potentially the most damaging event the dollar's structural position has faced in half a century, and why it is simultaneously one of the most powerful catalysts silver has ever been handed. Since the early 1970s, oil and natural gas, the commodities that the entire modern global economy depends on, have been priced and settled in United States dollars. Every nation that needs to buy energy also needs to hold dollars first. German economy, Japanese economy, Brazilian economy. It does not matter. If you need oil, you need dollars. That creates structural demand for the dollar that exists mechanically because the settlement system requires it, completely independent of whether American fiscal policy is responsible or American leadership is trusted. The Gulf producers sit on the other side of that arrangement and earn enormous dollar surpluses from selling energy to the world. Those surpluses do not sit in vaults in Riyadh or Dubai. They get recycled. That word, recycled, is the most important word in understanding how this whole machine holds together. Those surpluses flow back into United States Treasury bonds, American equities, American real estate, and in recent years, heavily into the AI and technology infrastructure propping up the S&P 500. The Gulf earns dollars from oil. Those dollars flow into American assets. American asset prices rise, confidence in the system is maintained, And Washington carries over $36 trillion in national debt without the bond market imploding, because that steady recycling of petrodollar surpluses provides a constant bid under Treasury bonds that keeps borrowing costs from spiraling. The wheel spins. The illusion holds. Now ask yourself, what happens when the Gulf begins to question whether the shield that justified their participation in that arrangement is real? The biggest mistake analysts make is imagining a dramatic announcement. Saudi Arabia holding a press conference to declare the end of dollar oil settlement. That is not how monetary transitions happen in history. What actually happens is quiet, gradual, and surgical. Sovereign wealth funds begin redirecting capital incrementally. UN-denominated settlements for Chinese oil purchases. Gold held in domestic vaults rather than at the Federal Reserve Bank of New York. Regional infrastructure projects in local currencies. Each individual shift looks small, but the aggregate effect over 12 to 24 months is a structural reduction in the flow of capital that has been supporting the dollar system for 50 years. And here is why this connects directly to silver. The dollar right now is the single force capping silver's advance. Every time silver tries to push higher, dollar strength pulls it back. Silver pushed to 85 at the open yesterday, got slammed back to 80 before recovering. The dollar is the ceiling. And a ceiling held up by 50 years of Gulf capital flowing automatically into American assets is only as strong as the system underneath it. That system just absorbed the most severe credibility damage in its history. When the dollar weakens from a structural level, not a temporary dip, but a genuine reduction in foundational demand, silver does not just drift higher. It reprices violently. Let me get to the math. Silver is trading at $86.43 per ounce this morning, Tuesday, March 10th, 2026. Gold is at $5,190. The gold-to-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold, sits at 59.1. 59 ounces of silver to match 1 ounce of gold. Pull up a long-term weekly chart of that ratio going back to 2011. In 2011, the ratio hit its cycle low at around 32. That was the last time silver was genuinely outrunning gold, with silver pushing toward $49 per ounce. The ratio then climbed for years and peaked at approximately 125 in March of 2020 during the pandemic liquidity crisis, 125 ounces of silver to match a single ounce of gold. Since that 2020 peak, the ratio has been compressing structurally. Lower highs, lower lows, a clear descending channel running for 5 consecutive years. Here's what makes the current setup so technically significant. If you draw the descending trend line connecting the lower highs from the 2020 peak downward, and you draw the ascending support line running forward from the 2011 lows through the subsequent cycle bottoms, those two lines are converging right now. A 15-year ascending line from below, a 5-year descending resistance line from above, both meeting at a zone between 55 and 65 on the ratio chart, and the ratio is sitting inside that zone today, right at the point of convergence. Compression like this on a technical chart does not resolve by drifting sideways forever. T breaks. And everything I'm about to show you about the fundamental picture points to the same direction for that break. If this analysis is useful to you, drop a comment right now. Tell me what country you are watching from, and tell me your instinct on silver at this point in the cycle. And if you know someone who holds silver or has been considering it, share this video with them today. The analysis we are doing here belongs in front of more people than the ones who already found it. My first gold target is $6,000 per ounce. Gold has been advancing through this entire bull market in roughly 20% increments, from 2,000 to 2,400, from 2,400 to approximately 2,900, from 2,900 to 3,500, from 3,500 to 4,200, from 4,200 into the 5,000 range today. This pattern has repeated 5 or 6 times across different market conditions. It reflects the way institutional buyers, central banks, and sovereign wealth funds accumulate gold in structured tranches. A 20% advance from current levels takes gold cleanly above 6,000. Pair that with a ratio target of 40, not arbitrary. 40 is the zone where the gold to silver ratio found major support multiple times during the 2010 to 2012 precious metals bull market. It held the low 40s repeatedly across different market environments. When a level holds across multiple years, it becomes a magnet during the next compression cycle. 6,000 divided by 40 equals $150 for silver, a 73% advance from where silver trades this morning. And that is the conservative first target using the most modest assumptions I can construct. My second gold target is $7,000, 2 consecutive 20% advances from current levels. Given that gold has made 33% moves in single legs during this cycle, that is structurally modest by comparison. Pair that with a ratio of 25. I know that number generates a reaction, but look at the historical record before you dismiss it. The gold to silver ratio reached the mid-20s in 1980. It reached 32 in 2011. In every major silver bull market of the past 50 years, the ratio has compressed below 30. 25 is not an outlier. It is a consistent feature of silver's outperformance phase in a full precious metals bull cycle. 7,000 divided by 25 equals $280 for silver. From $86 today, more than 3 times your current price. And if gold overshoots toward 8 or 9,000 on safe haven flows that are no longer being offset by dollar strength because the petrodollar recycling is slowing, then 9,000 divided by 25 is 360. I'm not making that my headline number because I want to stay grounded in what the data most directly supports. But the arithmetic is there. Now let me show you what the physical silver market is doing, because this is where the thesis gets its most concrete confirmation. The COMEX is the exchange where silver futures are traded and where physical delivery of actual metal takes place. Physical silver deliveries over the past 12 months have averaged approximately 43 million ounces per month, with monthly spikes reaching 75 to 80 million ounces. That is the highest sustained delivery demand in nearly 2 decades of data. At the same time, COMEX registered silver inventory, the metal actually tagged and available for delivery against futures contracts, has fallen to 81 million ounces. Total open interest on the exchange represents 294 million ounces in paper claims. That gives you a ratio of paper claims to deliverable physical ounces of 3.6. 3.6 ounces of paper silver for every single real ounce in the vault ready to be delivered. That is not a footnote buried in a quarterly report. That is a structural fault line running underneath the entire pricing mechanism for silver. The 4 largest short sellers in the COMEX silver market have cut nearly half of their combined short positions since 2024. JP Morgan alone took delivery of 3 million ounces in January. Bank of America has been stopping hundreds of millions of dollars worth of contracts. The banks that built the paper silver market, the ones who understand registered inventory data in real time because they are operating inside the system, are converting paper positions into physical metal and removing it from the exchange. Every ounce that leaves through physical delivery is one less ounce that can be leased, lent, or used to support a short position that keeps the paper price suppressed below where actual physical supply and demand would place it. The structural foundation that short sellers have depended on for years is being methodically drained month after month at a pace that has no modern historical precedent. The ceiling on silver is not gone yet, but it is developing cracks. And ceilings that carry this much pressure from below, where the structural support is being actively removed from underneath, do not hold indefinitely. Let me connect all of this together. When the Gulf slows its dollar recycling, 3 things happen simultaneously. The dollar weakens structurally because the mechanical forced demand supporting it is being quietly reduced. Gold accelerates because the 2 biggest drivers of gold price, dollar weakness, and geopolitical instability are both intensifying at the same time. And the gold to silver ratio compresses faster because silver benefits from both the monetary repricing that comes with a weaker dollar and the physical supply squeeze resulting from delivery demand overwhelming available inventory. These are not independent effects. They reinforce each other. The Gulf crisis did not create the compression in the ratio. That compression was already in motion. The ratio went from 90 in 2023 down to 59 today. That movement was driven by supply deficits, rising delivery demand, and the retreat of short sellers. What the crisis does is remove the one force that has been slowing the compression down, the dollar ceiling. Remove that ceiling, and every force that has been building underneath releases simultaneously. And precious metals markets do not ease gradually into repricing events of that nature. Now, let me give you the honest other side, because you deserve it. The strongest bear case for silver is the supply response argument. When prices rise, mining becomes more profitable. New mines open and existing operations expand. Supply eventually catches up and puts a ceiling on price. That argument has surface logic, but silver has been in a structural supply deficit for 5 consecutive years. Prices quadrupled from recent lows during that same period, and the deficit never closed. Opening a new silver mine from discovery to first production takes 7 to 10 years. Expanding existing operations takes 3 to 5. The supply response is real, but it operates on a timeline completely disconnected from the demand surge happening right now. By the time meaningful new supply arrives at scale, the repricing will have already occurred. The second bear case is that silver lacks the sovereign bid that underpins gold. Central banks hold gold. They do not hold silver. Without that sovereign floor, silver is more vulnerable during broad liquidity crises. Partially accurate. But silver was added to the United States critical minerals list. Classified as a strategic material essential to defense systems, renewable energy, semiconductor manufacturing, and advanced medical equipment. That industrial profile creates a demand floor that exists independently of central bank policy. And consider this, no major central bank holds silver today. What happens to the price the day the first one announces silver reserve holdings? That absence is not a bearish condition. It is the largest uncaptured upside catalyst in the entire precious metals market. 3 risks I want to name honestly. First, the dollar may not weaken as fast or as far as current events imply. If the Federal Reserve maintains restrictive policy and petrodollar recycling slows more gradually than expected, the ceiling persists longer. Direction does not necessarily change, but timeline extends. Second, a global liquidity crisis could force broad liquidation across all assets, including silver. We saw this briefly in March of 2020. Silver dropped sharply before recovering and running much higher. If you hold physical, be prepared for that psychological possibility, even when your long-term thesis remains intact. Third, a genuine technological substitute for silver in solar cells or high-frequency electronics could remove the industrial demand pillar over time. I do not see credible evidence this is achievable within the relevant time frame, but it is a real risk, and I am naming it plainly. With those risks clearly stated, here is where the math puts me. Conservative base case, silver at $150, driven by gold at $6,000, and the ratio compressing to 40. Moderate case, silver at $280, driven by gold at $7,000, and the ratio reaching 25. Upside case, silver above 300 if gold overshoots, and the ratio approaches its historical extremes. I'm not attached to specific dollar figures as though they are written in stone. I'm attached to the direction and the order of magnitude. In every version of this analysis, silver is materially, dramatically higher than $86. Let me make that tangible. 100 ounces of silver right now is worth approximately $8,600 at today's price. At $150 an ounce, those same 100 ounces are worth $15,000. At $280, $28,000. At $320, $32,000. The metal does not change. The ounces do not change. What changes is how the global market values those ounces relative to gold and the dollar. Scale to 500 ounces to 1,000. The math is identical. Here is a historical frame that puts these targets in context. In 1980, silver reached $50 per ounce. Adjusted for cumulative inflation since then, that represents over $200 in today's purchasing power. That was the high watermark under conditions that were structurally weaker than today. A supply deficit smaller than what we face now. Industrial demand a fraction of current consumption. Monetary debasement less extreme in absolute terms. If silver hit the inflation-adjusted equivalent of over $200 in today's money under those conditions, then the targets I walked through are not extreme. They may be conservative. Now let me give you the roadmap so you understand what you are watching as silver moves. Silver is at $86. The first leg is the range from 86 up to 100. When silver approaches 100, expect significant profit taking. 100 is a round psychological level that silver has never sustained trade above in its history. Traders holding from lower prices will take profits there. There will be a pullback that feels alarming if you are not expecting it. That pause is not the end of the thesis. It is how real moves build the base for the next leg higher. The second resistance zone is 100 to 115. This is where the previous major rally stalled before silver pushed toward its all-time high. There are sellers waiting to exit near break-even. The market has to absorb them. But once silver takes out the all-time high around $121, the character of the move changes completely. Above the all-time high, there's no overhead supply, no technical resistance from prior consolidation, no bag holders waiting to exit. The chart is open air. And when a commodity with this kind of fundamental underpinning breaks into open air after a multi-year base, the advance that follows is almost never gradual. My expectation is that silver moves from the all-time high zone directly toward the 140 to 150 range, where the first ratio target sits, consolidation there. Then the second leg, toward 280, begins as the ratio compresses from 40 toward 25. That is the roadmap. 86 to 100, first pause. 100 to 115, second resistance. Break the all-time high, acceleration toward 150. Consolidation. Then the real run toward 280 begins. And the catalyst that compresses that timeline from 3 years into 12 to 18 months, that event did not just happen as a distant possibility. It happened yesterday, in front of the entire world, on live television. The petrodollar recycling system lost the one thing that cannot be replaced with a diplomatic statement or a press conference. It lost trust. And trust built over 50 years of security guarantees and sovereign fund allocations does not come back with a phone call. Drop a comment below and tell me 2 things. First, what is your silver target and what ratio assumption are you using to get there? Show me the actual calculation. Second, does the petrodollar breakdown change your timeline? Does what unfolded in the Gulf yesterday make you think this move accelerates? I will read every serious comment and engage with the analysis. I will highlight the best thinking from both sides because I want this comment section to be the most substantive conversation about silver happening anywhere right now. Hit the like button on your way down if this gave you something concrete and new to consider. It genuinely helps this analysis reach more people. The petrodollar system survived 50 years not because it was economically perfect, but because the countries keeping it running trusted one thing. They trusted that the American security umbrella was real, that when missiles flew toward their critical infrastructure, the response would match the commitment. What happened on March 9th was a live test, the most consequential test the arrangement has ever faced, and the Gulf monarchies watched the result in real time on their own broadcast networks. Trust at that level does not shatter in a single morning, but it does not come back with a press conference either. It erodes in private meetings between finance ministers, in capital allocation decisions inside sovereign wealth fund headquarters, where the question shifts from whether to diversify away from dollar-denominated assets to how quickly it can be done, in choices to price incremental oil sales in alternative currencies, in decisions to hold newly purchased gold in domestic vaults rather than New York. Each individual move looks small. Collectively, over 12 to 24 months, they represent a structural reduction in the foundation that has supported the dollar's global position for 50 years. The most direct way for an individual investor to position in front of that structural shift is through physical silver, not because it is without risk, not because the path will be straight, but because every single force I walked through today, the weakening dollar foundation, the monetary repricing, the persistent industrial supply deficits, the record physical delivery demand, the retreat of institutional short sellers, the technical compression of the ratio at a 15-year convergence point, all of them point in the same direction. And they do not wait for mainstream analysts to connect the dots. They do not wait for sentiment to catch up. They move. I'm going to keep tracking all of this for you right here on Element Axis. The COMEX delivery data, the ratio, the dollar index, the signals from sovereign wealth fund allocations. Subscribe and keep your notifications on so you do not miss the next breakdown. And if there's a specific part of today's analysis you want me to go deeper on, whether it is the COMEX structure, the ratio history, or the petrodollar mechanics, drop that in the comments and I will address it directly. The math I showed you today is not opinion. It is 2 numbers and 1 division. An answer that changes the calculation on every silver position in the world. Verify it yourself. Challenge it in the comments. Tell me where you think I am right and where you think I'm wrong. That is the conversation worth having. And it starts right now.